Good dynamites. Welcome to the Mushin Trader, and this is part one, which is the I will teach you the definition and some terms and ideas for you to be able to begin trading forex. Okay, so what you're seeing on my screen right now is the platform that is widely used in trading forex market, which is the MT4 platform. Okay, and on the right side of my screen you see here numbers. This is the price. Okay, this is price, the price levels, and you could also see here time frames. I've just put it here on the right side, but you could put it here. You could drag this here, so maybe I'll just put it here so you could see better. Okay, so M1, as you see here, M1, it means 1 minute. This is the 1 minute chart. M5, which is the 5-minute chart. M15 means 15-minute chart. H1 is 1 hour, daily, weekly, monthly, and 4-hour chart. So it's the time frame. You click these buttons here to go to a time frame. So what does that mean? So right now I'm in the hourly chart. So one candlestick, this one, so this is a candlestick, this is a candlestick, this is a candlestick. So this candlestick would be trading or would be plotting a graph for 1 hour. So you know that you're in that time frame or in the time span. Okay, so what is a candlestick? So it's quite interesting for people who doesn't have any experience. I'm assuming that most of you who are watching this video have no experience in forex trading. So I'm designing my videos for people who doesn't really know how to trade forex. So for the advanced levels, please bear with me. So, and I would be explaining it in terms that is not too technical, so people could really understand. For people who are not into technical stuff or who are not technical savvy. Okay, so you see here this drawing here, this thin line and this thick line in a candlestick. So it's composed of two things: the wicks. Okay, let me show you that wicks and the body. Okay, so a candlestick is composed of wicks and body. So let me show you a picture. So this is an example of the components of a candlestick. So you see here a thin line and a thin line. So there's a thin line in the upper part and a thin line in the lower part. So since this is a green candle, it just means that this is a bullish candle. So what we mean by bullish is this candle was moving up. So let me just go back on the chart. So let me define the directions. You make money in forex by betting in the direction that you're predicting that the price would go. So let's say I believe that the price would go up. So I would bet, or I would go on a buy, or I would go bullish. So when they say bullish, it just means that the price is going up. Okay, that's simple. And when we say bearish, we're just saying that the price is expected to go down or is going down. And there's also another direction, which is what I made up a term for this. It's called crabbish. Crabbish is what this does. It just moves sideways. It doesn't go up as big as this. It doesn't go down as big as this. It just goes up and down in a certain range. This is a price range. So I'll put a box on it so you would see it. That is a price range. So it just goes up and down in that price range. That is a crabbish move or a consolidation, or what others call ranging. So let's go back to the picture. So when you hear people say buy, it just means that the price is going up, or you are going to bet on the price going up. When we say sell, it just means that you are going to bet going down, or what they call bearish. So why do they say bullish? Why do they say bearish in the market terms? So a bull attacks using its horn, pushing it upward, okay? And a bear attacks by using its claws, pushing it downward. So the market is a battle between the bears and the bulls. When we say a battle between the bears and the bulls, you cannot trade the market without putting one currency against another currency. So let's say in this example, euro is the bull and US dollar is the bear. So that is the battle between the bulls and the bear. So you need to trade in pairs for you to be able to trade in the forex market. And the major pairs that are currently traded are the euro, the pound or sterling, US dollar, and the Japanese yen. And you would pair this up with other currencies, like this example, the Australian dollar versus the US dollar. So that is how you trade the forex market, by putting one currency against another currency, and then you make money from the movement of the price from those currencies. So let me just show you. So let me just go back to the candlestick illustration. So when you see a bullish candle like this, a green one, let's say, but you could change the color of this on the platform, but for now let's just stick with green. So a bullish candle has some components. The upper wick, which it means that the price has reached this highest point, and the lower wick, which is the lowest point the price has moved in that time frame. So earlier I've shown you different time frames, 1 minute chart, 5 minute chart, hourly chart, daily chart, weekly chart. So let's say that we're on the hourly chart. When you see a picture like this, it just means that the price has moved in an hour the highest from this point, and it moved the lowest in that hour at this point. So the wicks define that. Now the body is the active price. This is where you make the money. This is where you make the money. So there's an opening and a closing. Why does it have it? So let's go back to the chart. Observe this candle right here. So there's a white line, and the white line indicates the current price. So what it means is that the price moves up and down in this hour. Right now the time on my country is 11:40 in the morning, and I'm on the 1 hour chart, meaning to say this candle will move for 1 hour. It will allow you to trade within 1 hour. So let's see what's happening right now. The price has moved the lowest in this hour here, somewhere here at 1.46620, and the price has moved the highest at 1.46787 for this hour. So that's the wick. Now what is the opening? So from the previous hour, this is the candle. So the candle from 11, so this is from 10 a.m. to 10:59. It closed here at this price, 1.46770. That's why the opening of the candle at 11 a.m. is at that price level. Now we don't see this price closing because we still have 20 minutes of trading. But let's go to the other candle. This is the opening of of the previous candle, and that was the closing. So let's go to the other candle. So this is a bullish candle and this is a bearish candle. So price went up and went back down and then closed here. When it closed here, this is the opening for the next candle, and then it closed here, and this is the opening of this candle. So I think you get the idea. So that's why in the definition, this goes up and closes upward, this goes down and closes downward. So that is the basic idea behind this candles. Now, for you to be able to understand it further, let's say $1. So let's say I have a $1,000 account. That is my capital to begin trading into the forex market. So I would be depositing $1,000 to my broker. So if I have $1,000 and what the price of $1 you see in the exchange rate is $1 is equal to 100.81 Japanese yen. So Japanese yen prices would be here, and then this white line would be 100.81. and what it tells you is that on that day the price exchange between US dollar and Japanese yen closed for the day at 100.81. That's why you get an exchange rate of 100.81. So the battle between the US dollar and the Japanese yen for that day closed at 100.81. So that's how you determine the exchange rate of the day. So moving on, so you already know the direction. Now, what is a pip? This is very important. What is a pip? Some define it points in pairs. So you have a currency pair that you're trading. So let's go here. In this case, euro versus the Australian dollar. So €1 is equal to, depending on the price move on this Australian dollar prices. So a pip is the number or the measure between one price to another. So the difference when you measure it is the pip. Okay, so that is the pip, to put it in a simple explanation. So let me give you a clearer explanation. So let's say, don't mind the numbers here for now. Let's say this number starts from 0, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So if I am expecting, so right now it says here that price, let's say, is at 5. This is 5. Let's not use this number, or okay, let's use this number now. 1.46732. So if my technique tells me to enter now, I would be buy, which means I'm expecting it to go up. So I'll put my trade here. When I click this, it will put a trade here. So I entered, or I put a bet on the market going up. So at 1.46730, and let's say I'm expecting the price to move up here at 1.47233. So the difference of that move is what you call the pip. So I use the cursor to measure. It's 50 pips. You can see here the number in the middle moves. So that is the pip. So it's in decimal places. So it shows 500, but this is really 50 pips or 50 points. The price has moved 50 points. So if that is the pip. So right now, if price is moving opposite of what I have predicted, that will be a negative pip. So if price move in the direction that I want, which is going up, I would be winning. But if price reverses on the direction that I don't want, this would be a negative pip. So if this is 50 pips up or positive 50, if ever the price goes down or the body goes down, that would be negative 9. So I would be losing 9 pips. So that is a pip. It's the measure we use of the direction or of the difference between the price movement for the currency pair. And then we're going to discuss this lot size. So how do you make money? So by putting in a bet or a lot per pip. So you see here, there's a value here. It says 1. So this is actually $10 per pip. So let me just show it to you in numbers. So for example, let me use another example. So my account is 1,000 US dollars. Okay. And let's say I won 50 pips. If I use a lot size of $1 per pip, I would be earning 50 USD, because that's 1 times 50 equals to 50 USD. But if my account will allow me to use $10 per pip lot size, a 50 pip move would amount to $500. So the same movement or the same points you harvested from the market exponentially changes depending on the lot size or the bet you put into the trade. And this is dependent upon how much is your capital, because there's a thing we call a margin. You won't be able to trade let's say $1 or $10 per pip if your account is only $10. That the system won't allow you, because they have preset margins depending on the broker. So if I have $100 US, then maybe I could trade $10 per pip. But the problem is, as you have seen earlier, if I entered here and I was expecting price to go here, but price did not go there and reversed here, this is, let's say, 9 pips, okay, and my margin is only, let's say, 5 pips, negative 5 pips. So if price reach -5 and it doesn't really touch my stop loss, the trade would automatically close and you won't be able to continue. So if price goes down and goes back up, you have already lost the trade in which you could have won, because as long as you don't close the trade, the money would not be deducted in your account. Because as the price goes up and down, up and down, up and down, let's say I am on a sell and my stop loss is here. So as long as this does not touch this, my trade won't close. So even if it goes back up here, but it goes down, and my take profit, let's say, is here, I win. But if my lot size is too big, even if my stop loss is here, even if this does not hit it here, let's say margin is around here, when price reaches this, your trade will close. So that is the important, and I will be making another video for that, so you would understand, and you would be understanding it in the next lesson. So leverage. So when you open an account, so let me show you. When you open an account, a new account in MT4, so I'll be making a demo account. So the good thing about FXtrading is you could use a demo account. When you use a demo account, you would be trading with real live prices without using real money. So it's like doing the real thing, but the money is not real. So you could commit mistakes and learn, but without risking anything yet. Okay? So let me just make a so the move so Mushin trader. Make me the Mushin trader. Okay. Put in your details here. Alright. Okay. So other, and now you deposit. So let's say $5,000. Okay. And you see here leverage. Okay. So what is leverage? So when you sign up for a new account, you would be seeing that pop up. And leverage. What is leverage? Leverage is it gives you the ability to trade bigger money or to loan some money so you could trade or you could win bigger money from the market. So let's say, let me give you an example so we would understand. Let's say you would want to buy a $100,000 house, but you only have, let's say, $20,000. So you won't be able to buy this house. So if you took a loan, you would be using a leverage of 1:5 for you to be able to buy $100,000 house. So 20,000 times 5 would be 100,000. So let's say if price move, so let's say you use this, and then if the price of the house went up to 200,000 by the next year or the next hour, your profit is equal to 100,000. So by using 20,000, you were able to profit 100,000 because of the leverage 1:5. If you would just be using 20,000, so so let's say the price doubled. So if you only have 20,000 as capital, your probably profit would be 20,000 without the leverage, because your leverage here is 1:1. And that's why leverage is important, because it gives you the flexibility or the advantage to earn more while having little amount of capital. So that is what leverage gives you. It gives you the ability to earn more with little capital, because your leverage is 1:5. Unlike when you don't have leverage, this is big. This has a big difference in your earnings. But leverage can also work against you if you lose. If your trades are wrong, you could be losing more than winning more. Okay? So that is basically how you define leverage. So now let me define stop loss. Stop loss is simply, it stops your loss. If you're wrong, it stops you from losing more. Take profit is your automatic target. So you place these things so that even if you are not in front of the chart, you don't need to manually close your trade. So let's say I would be putting a take profit, so I'm expecting this to go bullish. So if I enter bullish, sorry, when I'm in bullish, I want it to go up. So let's say I would go on a buy because I am expecting it to go bullish. When I press this buy, trade would enter here because the white line is here, and then I will put a take profit here. So when price moves from my entry to my take profit, it will close the trade, and I would be cashing in my winnings. So this is, let's measure, 80 pips. So I would be winning 80 pips, and it would close the trade multiplied by my lot size, and that will be added to my account. My stop loss, I'm expecting it to reverse up to here. That is the max. So you would be putting these things depending on the techniques that you would be learning. So as for now, just remember that you put your stop, because if this trade goes against me, I was expecting it to go up, but it did not. Let's say it did not. It still went down further. So when the body hits my stop, it would close my trade, and it would prevent me from losing more. Because if there is no stop here and the trend reverses continuously going down, it would end up hitting my margin and closing my account. So that is the purpose of the stop loss and the take profit. Okay, so a pending order is an automatic order. You just click here. So sell limit, you see here. So you're just saying that if I put a pending order here, let's just put a buy limit. You see the line? When this price hits it here, it would go on a buy. So if you're expecting price to go on a sell or to go on a buy on a certain price range, and you're not in front of your PC, you could use the pending orders. Okay, so that wraps up our training for today, and I hope that you review the video if you are a first timer, so you could understand more. If you have any questions, don't hesitate to put comments below. So watch out for more training videos, and get ready for part 2 for the introduction to the MT4 platform. So going around, you need to use the MT4. So I will be showing you how to use it, and also teaching you the basic trading technique on the next video. So see you then. Have a good day, and see you next time. Bye bye.